All right, let's knock out Chapter 12, Property Management. It's been a long time since we covered 2 chapters in one night. These are fairly short. We do have some math to go through in Chapter 12, but hopefully it won't be too bad if you've looked at that formula in advance like we talked about. So obviously, natural follow-up to landlord and tenant is property management. How do you manage property for a landlord? The first thing you need to know is the rules regarding property management in North Carolina. Property management can only be done by non-provisional brokers. This is not something that a provisional broker can do. So only non-provisional brokers are allowed to do property management in North Carolina. The definition, it says a property manager is somebody who preserves the value of an investment property while generating the highest possible return on the owner's investment. What part of that definition comes first? Generating return or protecting the value of the property?
Preserve the value.
Preserve the value, protect the value of the property is the number one priority of a property manager. So we want to make sure we're always doing that. That means we're going to be responsible for things like maintenance. That's going to be the responsibility of the property manager. Make those decisions to maintain the property. And then figure out how to generate a return on the investment of the owner. So we need to talk about what functions a property manager is going to have. One of the biggest is controlling expenses. So we need to introduce this idea of operating expenses. When we talk about managing property, particularly commercial property, these are examples of things called operating expenses, and you need to know them. You need to know what is an operating expense, and you need to know what's not an operating expense. If you remember that math formula that you memorized, isn't operating expenses one of those things you have to deduct out? So, you need to know what's included in that. Some examples: property taxes. Real property taxes are an operating expense. Maintenance on the property. Salaries. So what kind of salaries would you be paying if you were a property manager?
Maintenance.
So maintenance people,
Assistant.
like an office assistant, those kinds of people you'd have to pay their salaries. Marketing expenses, so any kind of advertising or marketing that you do for the property, utilities for the property, insurance, and then of course, don't forget to pay yourself a property management fee. All of those are examples of operating expenses. And one of the biggest functions of a property manager is to try to limit this, because this is going to have a direct impact on how much money the property owner sees as a return on their investment. What should a property management agreement discuss? So, number one, got to be in writing. Just like what other kind of agreement? A listing agreement. Remember, the only type of agency agreement we have that can be oral is what?
Lease.
That's not an agency agreement.
Buyer.
Buyer agency agreement. Buyer agency agreements can be oral for a certain amount of time, right? But listings can never be oral. Property management agreements can never be oral. You can't have oral property management agreements. It should specify how the management fee is going to be collected. Now, the most common way a management fee is collected is going to be some percentage of the rent that's collected. Not the rent that we might collect, but the rent that we actually do collect. Why do you think we do it that way? Why wouldn't the landlord want to just pay us and say, oh, well, you know, it's supposed to be $10,000 a month in rent, so we'll just pay you 10% of that?
Incentive to make us collect.
Incentive to collect. That's exactly right. If we are paid a percentage of what we actually collect, we have a very big incentive to make sure we collect that rent. It should have a termination date. All agency agreements have to have a termination date, but what does this say that's different than a buyer agency agreement or a listing agreement? It can renew. It can automatically renew. So let me tell you why it does that. To protect the tenants. Not for the landlord, not for the property manager. Think about the function of a property manager. What is their job from a tenant's perspective? What's the property manager's job? Everything. If I need to pay rent, who do I call?
Same guy you've been following for 2
The property manager. If I need to have repairs done, who do I call? The property manager. If there's somebody who's on the property who shouldn't be there, who do I call? Property manager. The tenants don't have any idea when my property management agreement expires. Does that make sense? So we don't want it just to expire and the property all of a sudden not to have a property manager. That's not fair to the tenants. So what we say is that these things can automatically renew. Basically, the outgoing property manager has to take responsibility for passing this along to the new property manager. You're going to have to send letters to the tenants and say, you're not going to be the property manager anymore. Here's the new property manager. Here's how you get in touch with them. This is where you're going to pay your rent. This is the number you're going to call for maintenance. That all is the responsibility of the outgoing property manager, because you have to protect those tenants. They have to be protected. Okay? And then finally, the property management agreement should outline how we pay the owner. How do we calculate, how do we account to them for how much money we owe them, and how often are we going to pay them? Are we going to pay them monthly? We're going to pay them quarterly? We're going to pay them annually? Whatever our agreement calls for as far as dispersing funds to them. That should all be in the property management agreement. All right? Our property management plan should plan for three things. What does the owner want from this property? Number one. What is it they want? Is it the best possible return? Is it improve the property? In other words, let's reinvest some of the profits and make it better. Is it, I'm going to tear it down in 5 years anyway, so squeeze every dime you can out of it? So the first thing you do when you're preparing a management plan is talk to the owner and say, what do you want? How do you want it managed? The second thing is to look at your competition. What kind of things would you look to the competition for if you're managing a property? What they're charging. Because you can't just say, oh, I'm going to charge $800 a month if your competition is all charging $600 a month. Or if they're charging $1,000 a month, you'd be silly to charge $800 a month. So you want to do an analysis of the competing properties. You want to see what they're charging. You want to see what their vacancy looks like. Because if they're charging $1,000 and they have 20% vacancy, well, maybe $1,000 is too much. So you want to look at that, the competing properties. And then finally, you look at your own property. The problem for most owners is they look at this in reverse. They look at their own property and they start to apply and say, oh, well, this should rent for this. Well, how do you know? You haven't even compared it to anything else yet. So you look at the subject property last. You look at the owner's objectives first, and then you look at your competition, and then you finally look at the subject property and say, this is how we need to be managing this property. You need to know what a cash flow report is. A cash flow report is a financial statement that shows how much money came in and how much money went out. Now, an operating budget is an estimate of that. So, you do the operating budget first. You budget first. And then a cash flow report is an actual statement of what did happen. So, an operating budget is a prediction of what you think will happen. A cash flow report is a statement that you provide the owner that shows this is actually what happened. Here's the rent we collected. Here's the rent we didn't collect. Here are the expenses we had. Here's the money left over.
You don't sound like you enjoyed that job very much.
I was not a big fan of property management. It's not my thing.
That's the first time I've seen you actually roll your eyes and then you really.
Yeah, it's not my thing. I will willingly admit this is either on the residential or commercial side. Property management is not my cup of tea. Some people love it. Some people love it because it's consistent money. It's one of the few areas of real estate where the money is consistent, because you're usually earning a percentage of rent collected, and the rent you collect from month to month stays pretty consistent, right? So it's not like a sales-based real estate career where you may have months where you make $20,000, $30,000 and months where you make zero, which can easily happen in a sale, the sales roller coaster, especially early in your career. One of the common traps that agents fall into early in their career is they work, and they're not making any money, and all of a sudden they get busy, and they have like 3 transactions going on. And they get so busy with those 3 transactions, they forget that they have to continue to generate more business. They stop doing the things that they did to generate those 3 transactions in the first place. And so then they close those 3, and guess what? They got nothing going on. And so now they go into that cycle again where they have 2, 3, 4 months where they don't make any money and they're scrambling and they get busy again and then they stop again. And so this is, seesaw thing. So property management has long been seen by people as more the steady, because I could have a consistent income. For me, I just was not something I enjoyed, either on the residential side or the commercial side.
You were a provisional broker when you were a property
No, I was not a provisional broker. You can't be the property manager as a provisional broker.
First pinpoint of the rest.
No, I was not. I was not. It's been a long time since I was a provisional broker. All right. This formula. Did we look at it?
Yes.
All right. So this formula. What did you say?
I said sober.
Well, you better know it, because this formula is going to be used over and over and over the remainder of the class. There's a lot of numbers on this formula that become very important when you start talking about investment math and returns on investment and value of income producing property. And so, like for example, in this chapter, we're going to look at a number called gross effective income. And what does it say in parentheses gross effective income is? That's kind of my definition of gross effective income. Rent actually collected. And the reason it's the rent that's actually collected is because we start up here at the top at something called gross potential income, which is, what's your potential? If you meet your potential, well, what does that sound like when we talk about with income? What is potential income?
You hit your numbers, hit your max.
Max. That word I like, right? Gross potential income is pie in the sky. It's not going to happen. It's the amount of rent you would collect if every unit you were managing for this client was occupied and every single one of the tenants was doing what? Paying on time. That doesn't happen, okay? And so with gross potential income, you're always going to have losses that come along the way. Whether you have losses due to vacancy or actual unpaid rent, they get subtracted out, and that gives us the gross effective income. So it's rent I might collect minus the rent I didn't collect gives me the rent what? That I not should have, did have collected. This number is fact. This is should have. This is I should have done this, but I didn't because I missed this stuff. So this is what I actually did. Yes. Yeah.
So in terms of types of, let's just say, apartment complexes, would student living be optimal then? Because generally student living is filled.
Right.
Well, yes and no. What's the obvious inherent problem with student living?
For kids.
Well, that too, but think about from a vacancy perspective.
They move in and out.
They move in and out a lot, which creates vacancy spikes, right? You have months out of the year where there's no occupancy whatsoever or very low occupancy. And a lot of turnover all at the same time, which creates challenges of its own. The ideal property to manage, let's say I have 100 units. The ideal would be to have 94, 95% occupancy. Not 100%. Because if I have 100% occupancy, I have no room to accommodate tenants moving in and out. If I have 95% occupancy, that means at any given time I have 5 units that are empty. Which means if a new tenant comes in, I have a place to put them, correct? It also means that when an old tenant goes out, I don't have this breakneck push to get that unit turned over because I've instantly got somebody moving in. Now, so the real question is, what is the difference between 100% occupancy and 95% occupancy? How do I take 100% occupancy and turn it into 95? And why would I want to?
Because it allows, essentially it would allow you, like you said, it would allow you to effectively turn over and bring in,
And what's the ultimate goal? Create more what? more revenue. So how would I take 100% occupancy and turn it into 95% occupancy without losing revenue?
Raise the rent.
Yes. If you have 100% occupancy, one thing is universally true. You ain't charging enough. Anytime you're at 100% occupancy with that number of units, the rent's not high enough. You should gradually ratchet up the pressure until you can create some vacancy space. Because let me ask you this question, just do the math on your calculator. Would you rather have all 100 units full, paying $1,000 a month, or would you rather have 95 paying $1,100 a month? You'd rather have 95 paying $1,100 a month. It's more revenue. And you've got some space, you've got some flexibility to accommodate that tenant coming in. Because the problem with 100% occupancy is you can't stay there. It's impossible. Eventually somebody moves out, and it takes time to turn that unit over before, even if you got a waiting list, it takes probably a month to turn that unit over, so you're going to have some vacancy. So let's push the rent to a level where we have a little bit of vacancy, but we haven't sacrificed revenue for it. That's ideal from a management's perspective. Okay? So make sure you know these terms. Gross potential income, that's the rent what?
You should collect.
Rent you should collect. If everything's full and you charge them full price and everybody's paying rent, you should collect. And once you subtract what you don't collect, what are we left with?
What you actually did collect.
What you did collect, which is called what?
Gross effective.
Gross effective. It still has that word gross in it because we haven't subtracted what? Expenses have not come out. Look at the next step. What comes out next? Operating expenses. Remember that slide earlier? We said property taxes, salaries, maintenance, utilities, marketing. What else?
Property management.
My property management fee comes out. But remember, we're going to have to calculate that property management fee. It is an operating expense, but how do we calculate it? What did I say? It's usually a percentage of.
The rent.
What rent? We got a lot of rent on here. Which rent?
The gross potential.
Actually, what is it?
Not gross potential.
Gross effective.
Gross effective. It is a percentage of the rent that is actually collected. So in order to calculate this management fee so that you can subtract it out, you've got to go up here and look at the rent you actually collected. Does that make sense for you guys?
Yep.
So this line is going to be really important to us in this chapter because this is where we're going to calculate a property management fee. Now, the formula for calculating a property management fee is a T-bar, like most things. And it's the effective gross income times the rate equals the property management fee. So, of course, property management fee divided by effective gross income would give you the management fee rate. And we all know how a T-bar works at this point in time, right? So, effective gross income, which is the rent we collected, times the rate of the management fee is going to give us the property management fee. And we're going to do some of that here in just a second. All right? Establishing a rental schedule. How do we decide how much to charge for rent? And I would say to you folks that when you're studying this chapter, you can study almost exclusively from the slides in this chapter. I mean, I think just about everything that you could potentially be tested on in this chapter are on these slides. All right? They get long-winded in this chapter unnecessarily, I believe. So things that we look for when we charge them rent, or deciding how much rent to charge. Do you think it's going to be important to look at how much the expenses are for this property?
Yes.
Yeah. Isn't that part of that operating budget? Budget for property taxes, budget for insurance, budget for maintenance, budget for my fee. So we've got to charge at least enough rent to cover the operating expenses. Does that make sense?
Yes.
Then we've got to add an investment return. The owner doesn't want to own this thing and make zero money, so they need some money left over after all those operating expenses. And then we have to make sure that those numbers line up with our competition. Once we come up with the numbers we need, then we compare those to the competition. And does this rent make sense? Does this number make sense given what the competition is doing? And then, of course, what does our vacancy look like? You know, if our vacancy is really high, then we have a problem. If we don't have any vacancy, then we might have the opposite problem. That's going to also dictate how much we charge for rent. On a test, a big one though, looking at the competition. Don't forget that. Any kind of pricing that we ever do in real estate, any kind of valuation, because how much to charge for rent, isn't that just an opinion of value? Telling my client, my landlord, what I should charge for rent is no different than telling my buyer what they should offer on a property they're buying. It's expected part of my job to provide that advice. Well, the first place I'm always going to look when I'm trying to provide an opinion of value is the competition. What are competing properties doing? Duties of the property manager: market the property, collect rent, choose the tenant. Remember we talked about, way back when, we talked about 3 different forms of agency relationship, or 3 different levels, not forms, levels. We talked about special agency, general agency, universal agency. We said that universal agents had what kind of power? Unlimited. All the power, all the decision-making authority for their client. We said real estate brokers would never be there, right? We said general agents had some power to make some limited decisions on behalf of their client. And special agents have what kind of power? What kind of power though? None. It's exactly right. No power. A special agent has no power. They can only relay information. Sales agents are special agents. If I'm working in a sales transaction, what decision-making authority do I have? None. Who's making the decisions? Buyer and the seller, not me. I'm just presenting them with stuff. Is there some decision-making going on here? Give me examples of decision-making right there. That second one right there is a big one, right? How about this one right here, maintaining the property? I'm not asking the landlord if I call the HVAC guy. I'm doing what? Calling them. This decision-making, that puts us out of special agency. What are we in? What kind of agency are we in here as a property manager? This is general agency. This is general agency. This one's a big one. Perform the landlord's duties, even going to court. So if the landlord wants to file for summary ejectment, who's going to file for summary ejectment? The property manager. Who's going to attend that hearing? The property manager. As a matter of fact, it has to be the property manager, because usually if a landlord wants to evict a tenant, it's because they haven't paid what? They haven't paid rent. Who was collecting the rent? The property manager. So the judge is not going to want to hear from the landlord. They're going to want to hear from the person collecting the rent, so that you can testify they didn't pay the rent. All right? You need to know different types of maintenance that property managers could do. The most cost-effective type is preventative maintenance. Preventative maintenance is maintenance you do before something breaks. Corrective maintenance is maintenance you do what? After something breaks. And deferred maintenance is maintenance you didn't do at all, which leads to a decline in the value of the property. So preventative is done before it breaks, in hopes that it won't break. Corrective is done after it's broken. And why would corrective be more expensive than preventative?
For nothing else, surely convenience.
Convenience. Usually with corrective maintenance, is it kind of a rush? Stuff's broken. You got to get it done quickly. Are you going to have to pay more for that kind of maintenance?
Yes.
Whereas with preventative maintenance, couldn't you have somebody who does those odds and ends things when they don't have anything else to do? It's much cheaper. It's more efficient to do preventative maintenance. And then deferred maintenance, of course, is maintenance that just didn't get done. That's what deferred means, put off till a later date. We talked about this before. We talked about it going through the license law and rules the other night, but it's a good time to point it out again. Salaried employees of real estate brokers. Can they perform a lot of tasks related to property management? Yes. Can they collect rent?
Yes.
Can they do maintenance requests? Can they deposit money in the trust account?
Yes.
Balance the trust account?
Yes.
Show that property that's for rent?
Yes.
Yes. There's one thing they cannot do is engage in a negotiation. They can't negotiate with the tenant. Now, they also can't show properties that are for sale. Can show ones for rent, but not ones for sale. And then last note here before we get to the math, the ADA, the Americans with Disabilities Act. This is big for property managers in commercial settings. Now we're going to talk about the Fair Housing Act a lot in chapter, I think it's 21, the Fair Housing chapter 21, 22. We're going to talk about the Fair Housing Act, and that affects residential properties. But the Americans with Disabilities Act affects public areas, like this building. This is a public building. And so the Americans with Disabilities Act says that if you're managing properties that are public accommodations, you have to make them accessible to everyone regardless of handicap. Now, you can make them accessible through one of two things, either an accommodation or a modification. An accommodation is a change in the way you operate. A modification is a change to the physical structure itself. You know, like for example, in my hometown, the post office is a couple hundred years old, and it's a granite building at the top of 20 granite stairs. No elevators. So obviously, if you're a handicapped person, you are not getting up there. It would be almost impossible to make modifications to that building. So they have handled access with an accommodation. If you have a disability and you cannot go up into the post office, you pull around back, and they have a little buzzer, and you press it, and somebody from the post office staff comes down and say you need to get stuff out of your post office box. They take your key, they run up there, they get it out, and they bring it to you. That is an accommodation. They're changing the way they operate to provide you with accessibility. A modification would be something like an elevator or a lift or a ramp. That's a change to the physical structure. The ADA is not explicit about which it has to be. Generally speaking, one or the other will do, unless it's newer construction, in which the case the building code requires you to build it to ADA standards. In other words, you're modifying because you're building the property. So examples of things that we had to do in this building. There can't be any round door handles. That's not ADA compliant. They have to be the lever type handles because people who don't have grip strength cannot turn a round handle. You know, wider doors that would accommodate wheelchairs, of course, and you know, bars in the restrooms. All those things. Being on the first floor or being in a building with an elevator. Now this is both, actually. We're on the first floor in a building that has an elevator, so it works from both perspectives. But all of those are requirements of the ADA. And those are for what kind of facilities? For what kind of buildings?
Public.
Commercial or public, absolutely. And just so you know, as far as animals go, service animals. I always give people this note with service animals because service animals are dramatically different for public places versus residences. The Fair Housing Act and the Americans with Disabilities Act have different definitions of service animals. Here's the important thing to know. They don't have different definitions of what you're allowed to ask. You are allowed to ask 2 questions and 2 questions only. Whether we're talking about public facilities or residences, just 2 questions. The first one, do you have a disability? If someone presents themselves with a service animal, you're allowed to ask, do you have a disability? Now, did I say you could ask what it was?
No.
How long you been disabled? You don't look disabled to me. Can you? No. Do you have a disability? If they say yes to that question, then you can ask the second question. Is the animal trained to provide assistance with that disability? Those are the only 2 questions. Can you ask for verification, a certificate, a vest, I don't know, make the dog walk backwards? No, you can't ask for any of that. You ask those 2 questions. That's it. Now, when we're talking about public facilities with the ADA the ADA specifies that service animals are either canines, so dogs, or miniature horses. That's it. Dogs and miniature horses. No cats, no rats, no bats. No snakes,
Pigs.
no pigs. Canines, miniature horses. Miniature horses are awesome.
Essentially one service.
I know,
Yeah,
they're
they
so
are.
cute.
They
They
look a
are.
little-
There's a lady in Chapel Hill that has one. It's the most awesome thing I've ever seen. He has little Nikes he wears. It's the greatest thing you ever see. He has his little Nikes on and he goes all around town.
They're
Yeah.
adorable. I want one.
He's about 200 pounds. I mean, miniature, still pretty big, but you
They
know.
are.
But she needs him. She's blind, so he's vision assistance. But now she's getting older, so he also provides stability. So he wears a harness that's like really tall, you know, and it has a wide handle on it, and it doesn't twist. You know, it's the way it's like hooked around his legs. She can push on it, and it doesn't. So he provides her not only with vision assistance, but she can lean on him. You know, and for example, if she drops something, she can, you know, hold and bend down, you know, with him. So, and the reason for miniature horses is they live so much longer than dogs do. People don't have to learn new animals on such a, you know, because service dogs only have a working lifespan, most of them, because they're big dogs, of about 8 or 9 years at tops. Whereas my understanding with the miniature horses, it can be 25 years. So it's significantly longer. And you think about what a difference that makes in, I mean, how dependent that person would be on that animal to not have to change, but, you know, a third as often would be huge. So, but that's very different than the Fair Housing Act. The Fair Housing Act doesn't have any breed or species restrictions. So yes, service snakes and bats and all kinds of stuff in housing. But in a public place, in fact, did y'all see the peacock? Did y'all see that on the news this week? Some lady in California tried to get on a plane with a service peacock. Showed a picture of the thing sitting in the airport, and they denied it. And as soon as I saw the headline, I was like, well, they don't have to accommodate that. And then I read it, and that was exactly what the airline statement said. It said, we're in full compliance with the Americans with Disabilities Act. You know, we welcome qualified service. They didn't say what qualified service animals were, but I know what they are. They're dogs and miniature horses. Peacock is not one of them.
Now, what do they do about the miniature horse bathroom habits?
He's trained.
He is.
He's like a dog. I mean, he lets her know when he needs to go outside, and she has a pooper scooper, and
So if they're out in public, he doesn't? Or-
I've never seen him do it. I think he's pretty well trained to go, you know, and I'm sure she doesn't stay out for 8-10 hours at a time, you know, but she rides the van in Chapel Hill. They have you know how they have the van service that pick people up. She calls the van and picks him, and he rides in the front seat. She sits in the back and he sits in the front. She gets in the front seat and he gets his little seatbelt on. The seatbelt goes through his harness, and the van driver, so like the harness, like the handle flops down so he can get in the seat, and he climbs and jumps up in the seat, and they hook him in with the seatbelt, so you'll see him going down the road like a horse.
That's so cute.
Yeah, he's great. He's great. I love his shoes. That's the best part. The Nikes is the most awesome thing in the world. I saw that. I was the first time I saw it. Does he have shoes? Are those Nikes? Like, oh, the greatest thing ever. So, yeah, she's a super nice lady, and she's very, you know, she's very aware that people are fascinated by him, you know. So she's very open to, you know, like people going up to him and stuff like that. You have to remind yourself though, the animal's working. You know, he has a job to do. Don't, you know. So you try to, like, if you see kids like running up to him or something, you know, a lot of times you'll see people just kind of say, no, don't do that, you know, and wait till she's sitting down, or, you know, when he's not guiding her somewhere, because he takes her through the intersections and everything. He knows the buzzers for the traffic lights, and you know,
Wow.
yeah, he's super smart.
Yeah, most always have harnesses like that. They've got like little handles in the back. You can run the seatbelts through.
Oh yeah, there you go. All right, so let's do some math. Take out the worksheet that I passed out. And we're going to be working with that formula So you might want to get your formula sheet out as well, so you have access to it. And I will pull it up here so we can refer back to it as well.
But he's blind, but nothing else.
Alright,
He do everything like he does everything.
so look at number one. Number one says calculate the gross potential income. Calculate the gross potential income for a property with 18 commercial units that each rent for $12.50 per month. Now, it's easy right now to just say, okay, well, that's going to be 18 times $12.50. Here's what I do though. If you'll get in the habit of writing that formula out, as these get more complicated, you'll see where to start to fill things in. So it's going to seem tedious on the first couple, but I promise there's method to my madness, okay? So here's what I write down. I don't do it in a detailed way. I just do like this. I just do GPI, gross potential income, minus vacancy, equals what?
Gross effective income.
Gross effective income, minus what?
Operating
Expenses, operating expenses, equals what?
Net operating
NOI, minus debt, or mortgage, right? Equals before tax cash flow. I just kind of write that out, so I can start filling things in when I do these questions. Number one is real simple. It says calculate the gross potential income for a property with 18 commercial units that each rent for $12.50 per month. Well, gross potential income is always up here on the top line, so we've got 18 times what? 18 times $12.50?
Yep. 22,500.
Close. What do you think we gotta do still? 18 times 1250 is close. Everything in this formula is meant to be annualized. This is an annual cash flow worksheet. So if they rent for that monthly, what are we gonna do with that number? Times 12. And when we multiply it times 12, we end up with a gross potential income of $270,000. How do we feel about that one? Okay? Pretty simple. I'm going to go ahead and write down my formula again. Gross potential income minus vacancy equals gross effective income minus expenses equals net operating income minus debt equals before tax cash flow. Alright, calculate the effective gross income of the above property if 15% of the potential rent is not collected due to vacancy or non-payment / collection losses. So, gross potential income was what? We calculated on the previous screen, right? What was it? $270,000. So I'll just write that down. Now, they want us to calculate the effective gross income. So we're going right here. This is our destination. They want us to calculate the effective gross income if we're losing 15% due to vacancy. So we want to take 15% away. So 270 times 15%. What do we come up with for our vacancy?
40,500.
40,500. So minus 40,500. See how I'm starting to set that up? I make the chart and then I kind of do my notes on the right and my math on the left so that I'm just piecing it together, because as you get deeper into this formula, the numbers are going to start to swim around if you don't have like placeholders for it. So, what is my gross effective income going to be? 270 minus 450. I've got 229,500. I like that. 229,500 for a gross effective income on that property. Everybody okay so far? So in other words, rent we actually collected on that property is $229,500 per year. Okay? Number 3, I'm going to keep the same chart up. Now wants us to go to what? They want us to calculate the property management fee, right? They want us to calculate the property management fee, which is an expense. It goes on the expense line. Calculate the property management fee, assuming the brokerage handling the property management is charging a 10% management fee. So it goes over here on the expense line, but what number are we basing it on? What number are we at 10% of what? The gross effective. So 10% of 229,500 times 10% equals 22,950. So $22,950 is my property management fee. And that would be an expense. That would go on the expenses line. Even though it's calculated based on the gross effective income, remember it's an operating expense. So that's the line where it would get subtracted out. They didn't ask us to subtract it out. They just want to know what the property management fee is.
I feel sure you can manage more than one property at a time.
Sure you can. Most residential property managers who do it full time manage about 100 units.
That is solid money.
Okay? Number 4, calculate the annual property management fee for a 20-unit apartment building with the units rent for $800 monthly and the property has a 10% vacancy rate, while the property manager is charging an 8% management fee. So this is sort of piecing it all together. We've got gross potential income minus our vacancy equals gross effective income minus our operating expenses. I'll just put OPEX, operating expenses, equals net operating income minus our debt equals before tax cash flow. So I write it down. Calculate the annual property management fee for a 20-unit apartment building. Well, what line is the 20-unit going to go on? What do I need the 20-unit to help me calculate? The gross potential, right? So it's going to go up there at the top. 20 units times what? 800 times 12, because everything in this formula needs to be annual, right? I wouldn't do that math yet. See, I'm not saying you're wrong to do it. What I'm saying is, you start going back and forth to your calculator, that's when numbers start swimming all across the page, right? The whole point of setting up something visual like this chart is let's read through the whole thing, let's put every number in its place, and then we'll do the math. Does that make sense for you guys? Okay, so we've done the 20 units rent for 800 at 12 months, has a 10% vacancy rate. So if I've got a 10% vacancy rate, I'm just going to put over here on my note side minus 10%. Okay? And I'll do the math when I get there. And the property manager is charging an 8% management fee. Well, what line does the management fee go on? That's an operating expense, right? So I'm going to put 8% down here for my management fee. And that's the number they want to know. They wanna know that 8% management fee. That's my goal right there. So now, let's do the math. I switch over to the left-hand side, I'm just gonna go 20 times 800 times 12. And that is 192,000 for gross potential income. And 10% of that, so I'm losing 10%, so 10% of 192 is 19,200. So I'm subtracting out 19,200, and that will give me a gross effective income of 172,800. How do we feel so far about that number? Is everybody okay with where I'm getting that number from?
Yes.
Now, what they want to know is what is that 8% property management fee? That 8% property management fee is going to be 8% of my gross effective income, right? So, I'm just going to take that number and multiply times this number right here to get my property management fee. So, times 8%, and my management fee is going to be $13,824 per year for managing that property.
Oh,
Sorry,
I moved a step ahead.
you moved a step
I
ahead.
didn't stop when I got 13, 18, 4.
You didn't stop, what'd you do?
I used that number to subtract it.
You subtracted it?
That 13,824. Yeah.
Uh-huh. So what did you calculate?
158.96.
I don't mean the number. Name it. What did
Oh,
you
the net
calculate?
operating income.
You calculated the net operating income because you subtracted out operating expenses, right? But they didn't ask you for that. They asked you for the management fee. Okay? Everybody feel good about this so far? Okay? So let's look at the next one. It says calculate the net operating income. Well, here you go, Josh. Your time shines. This is what you wanted to do, right? So before I even read any further, I'm just going to go ahead and write my formula down. GPI minus vacancy equals gross effective minus operating expenses equals NOI minus debt equals before tax cash flow. If you just condition yourself to write it, you'll never forget it.
Right.
You've written it so many times, and then you start filling it in. All right. So we want to know net operating income. So I kind of always like to circle where I'm going. And I'm going right here. That's my goal. Okay, so now let's start filling the information. Calculate net operating income of a triplex property. What number do you think I'm going to write down first?
3.
3, because a triplex has
3 units.
3 units. So my rent's going to be 3 times something.
750.
That is fully rented, each unit generating $750. And we can always add what there?
12.
Times 12. So 3 times 750 times 12 are what my notes are going to be on that line. And a 10% annual collection loss. So I'm going to put 10% minus 10% on my vacancy line here. That is managed by a broker property manager who charges a 10% management fee. So I'm going to put minus 10% on my operating expenses line. The property has annual repair costs of $800 per unit. So repair costs, what line is that going to go on? That's an operating expense, right? All right, so we also have over here 800 times what?
750.
Times 3. Not times 750, okay, times 3. Because it's $800 per year in maintenance expense for each unit. How many units do we have?
3.
3 units. Does that make sense for everybody?
Okay.
Okay? And the annual property taxes on the triplex are $5,600. What line does property taxes go on? That's also in operating expense. So we're going to put that up here as well, $5,600. So I got three things to deal with on the operating expense line. So start at the top, start with my gross potential income. 3 times 750 times 12. I've got $27,000 in gross potential income. How do we all feel about that?
Yes.
Pretty good on that? And we're going to subtract 10% vacancy. So times 10%, I've got minus $2,700 in vacancy. And if I do that, that's going to give me a gross effective income of $24,300. Everybody okay with that number?
Yeah.
Good. And then we want to subtract all of these operating expenses. So the operating expenses, the first one is the 10% management fee. 10% of what number? 24,300, right? It's always 10% or whatever percent of the gross effective income. Does that make sense for everybody? So we want to subtract minus 2430 because that's the 10% management fee. Also, we need to subtract 800 times 3, which is another $2,400, right? Everybody okay on that?
Yes.
And we need to subtract out the $5,600 in taxes. So, if I go with 24,300 minus 2430 minus 2,400 minus 5,600, I get a net operating income of $13,870.
A month?
Is that not what you got?
Yeah, I got it. I'm saying, like, I'm just thinking as a owner of something like this. But it's only, I think that's a triplex, so it's a good cash flow.
Well, it doesn't, you can't determine if it's a good cash flow because you don't know what you've done what with it. If you paid $1,000 for it, would a $13,000 return be a good return?
Right. Oh, so I don't know.
Would it?
Yeah.
If you paid $20 million for it, would a $13,000 return be that big a return? So then what key piece of information are you missing before you declare this is a good or bad investment?
How much paid for it?
How much you paid for it? We have no idea what they've invested in this thing. You can't sit there and go, oh, it's terrible, I'm not making any money. If I only paid $5 for it, it's a hell of a return. If I paid $5 million, it's a crappy return, right? So you can't make those sort of determinations unless you know what was invested in the property. All right, let's see here. Number. Why don't you go ahead and do number 6 and 7 on your own? And we'll see, I'll do them and put them up here. Give you a couple minutes to work on. Now, before you tackle those, let me point out something to you. On operating expenses, mortgage is not on that line, is it?
No,
It's on the debt service line. Be careful about mortgage payments.